Hello traders, this is Dan, and in this Master Trader weekly trade review, I'm going to show you an option strategy where we sell options and profit in range-bound markets. Stocks can only do one of three things: uptrend, downtrend, or sideways trends. We have stock and option strategies for every single trend. We have different compelling patterns where we can buy or sell options. When we are selling options and spreads, we're technical based patterns, and we're placing a bet, if you will, that whatever strike price that we're going to sell, it's not going to be violated by expiration. And then we keep that money as our potential maximum profit. So on bullish patterns, they can be on uptrends, they can be on sideways trends. Then we're going to sell an out of the money put spread, and we're going to profit in 2 out of 3 directions. We profit if the stock goes up, if it just chops around sideways and does nothing, and it can even go against us all the way down to our break-even point, and we still make money. It's an incredible strategy. We do it every single trading day. And it's like this little guy over here saying, you know, I don't care what you do, just stay away from my short strike and I make money. Bear call credit spreads on any bearish pattern. We're going to make money if the stock goes down, chops around sideways, and it can even go up a little bit all the way to my break-even point, and I still make money. So we call the money that we receive, look, I got a cushion to be wrong. When you buy stock or short stock, you are penny for penny, either it's in your favor or going against you. I call this similar to like an insurance company or even running a casino, that you're collecting money over and over and over again, and you profit from time decay and volatility contraction unless you get a big adverse move or gap against you. But that's going to happen if you're trading stocks also, and we have a higher probability of profit when we sell options by definition. These are what we call bullish money patterns, that if I were just shorting a naked put or a put spread, we start with a pattern, and I say I don't think the stock's going to violate this short strike within however many days to expiration. We collect that money, and that's our potential maximum gain. The only difference in a credit spread, this is what's called a bull put credit spread. We're selling one strike, taking some of that premium and buying a further out of the money put strike. And the difference is the net credit immediately deposited to your brokerage account, and your max gain is the credit received, max loss spread with less credit received. Take that same concept in what about range bound? So what we're going to do is we're going to short an out of the money bear call credit spread over resistance. We're going to simultaneously short an out of the money bull put credit spread under support. The max profit now is both of these credits combined. So we're making money on 2 spreads instead of just having a directional bias on one. The max loss, again, strike with less credit received. But remember, we're collecting 2 credits, so it's bigger here. What are my break-evens? This is what's called a risk graph of an iron condor. So this horizontal line in this particular example is my max gain. My potential max profit always is the credit received. My max loss is if it goes above the bear call credit spread, short strike, or below the bull put credit short strike. But we never let that happen the way we manage it with the charts, of course. And so, you know, sometimes I think it's like, it's a funny analogy. You walk into Wynn Casino and you say, hey, sir, can you tell me where the table is where I can make money with the stock going nowhere? He's going to look around and say, sir, you're in the wrong place. And that's the beautiful thing with options, is we have options, as we say. Options provide options, trading options. So here's just another way of looking at it. I want a range bound with major pivots highs, major pivot lows, multiple and wide distance. So here I'm going to sell my put spread under support. simultaneously sell my call spread over resistance. Although not shown here, just a visual aid. I like flat major moving averages, just kind of confirms the short, medium, and longer term trends are flat. And then I manage it in between. I have stop losses above and below. This is a trade automation that we gave to our subscribers a week ago. So income trade and range bound markets. Look at this mess. This is in a wide trading range. Major pivot resistance above, major pivot supports below. Actually kind of made some higher pivots here. Look at my blue is the 20, green is 50, red 200. All three of these trends are going sideways, these three moving averages. So I have the major pivots, check, perfect starting candidate for an iron condor. Now, the majority of the time, we have more of a bullish or bearish bias as chart readers using the master trader approach on multiple time frames. And so we typically start with just one credit spread, but we might use a condor as an adjustment strategy, which I'm not going to talk about today. I'm talking about what are the patterns that I can have my opening trade as a short iron condor. This is textbook. We gave this to our subscribers last week. We said short under support here, the 100, way the heck down here, 190 put spread, simultaneously sell, look, $5 higher than this. You can't even see it. So we shorted a 131.40 $10 wide call spread. The total credit we got for that was $1.55. This one, it didn't have weekly expirations. We typically like selling options that expire 10 days or less just for the more rapid time decay, but this one was 25 days, and we're okay with that because it's so wide. We took in $1.55, so our max loss is $8.45 a share. That gives us a potential maximum return on capital, 18.3%. And for us to make that maximum return on capital, it just has to close at expiration below my short strikes. So that means below 130 and above 100. So it can bobble around in a $30 range and I make my money. This is unheard of if you were trading stock. And so that my break evens though, my break even is my short strike plus the credit received, or short put strike minus the 155 credit received. And then, we just stop out of the position, either above resistance or below support. And it's up to you if you want to keep the winning side if you do happen to get stopped out. But we typically close the whole thing just because you'll be pretty darn near max potential gain on the win. So this is same chart, AutoNation, 5 days later. How did we do? Well, stock continued to behave beautifully. Look, so 1, 2, 3, 4, 5. We had 5 market days here, and it gapped up, came in, stayed range bound, still flat MAs, doing exactly what we wanted it to do. When we sell options, remember, it's like a melting ice cube. So 5 days later, what we had sold for $1.55 a share, this was at Friday's close. So we could have closed this out at 88 cents a share. So the difference of 155 and 88 is 67 cents divided by the potential max gain of 155. We have 43% unrealized gain right now. And the stock's doing absolutely nothing. On a 10 lot, that would be $670 you made in 1 week, and the stock went nowhere. Come check us out if you want to learn how to do this yourself. We obviously have our weekly options trader, which sends you these trade ideas, but if you want to learn to do them yourself, we have advanced credit spread course. We have an awesome mastering advanced credit course, 12 detailed modules. Go to mastertrader.com/spread trader. And we obviously buy options also because of the the limited risk and leverage, and we can actually flip the risk curve to give us a higher probability of profit also in buying liquid options. Hope you enjoyed that. As always, email me with any questions, and look forward to seeing you in the next Master Trader Trade Review.